Hello and welcome to another exciting episode of Finance Footnotes. I am your host, Brent Stransky, joined as always by my friend and colleague and co-host, Zach Miner. Today is May 21st, and we're going to be talking about some of the goings on in the marketplace, including where markets are at the moment, two reasons why they are where they are, one reason to be optimistic, and it looks like, Zach, you have a couple of reasons why we should maybe add a dose of pessimism to our
I
thoughts.
wouldn't
What do
say
you
it's
think?
I wouldn't say it's pessimism. It's just we're getting close to election time, so there's some things that the candidates probably won't talk about that we probably should talk about. And then just bouncing around a little bit. I wouldn't say they're pessimistic. They're more just realistic.
Yeah, realistic. That was the word I was looking for. Apologies there
Yes.
for
So
but
some
let's
social security stuff, some estate tax stuff, international politics stuff. So
people love talking about it. So it's going to be exciting and punchy podcast here. We're going to try to keep it a little tighter than usual. So let's just press right on into the notes here. The first chart I'm showing everyone at home, per usual, is from the Wall Street Journal this morning, showing you where the primary markets indexes are as of yesterday close of business. And you can see ATH all-time highs. Markets have grinded higher. That's across all the indexes, but particularly the S&P 500 and NASDAQ are at all-time highs. And I guess the Dow is just a shy no away from an all-time high. We're looking there at that chart. I wanted to point out one thing, Zach, and maybe you could fill in the gap here just quickly. At the bottom of all three charts, it shows you kind of a line, a trend line, 65-day moving average. Can you remind the folks at home what that means and why it's important?
Yeah, it just smooths out the daily bars that you see there and just gives you a sense for how the averages are moving over a longer period and kind of gives you a bit of a smoothing effect to it. And then it also can provide you with a price of support or resistance. The 65 day I wouldn't say is too powerful from a point of resistance and support. That's more kind of like the 200-day averages, a little bit longer term averages, where if price pulls back to that or gets up to that, you can kind of say, hey, that's a good that's a point, an inflection point in the market. But the moving averages themselves, I think, just give a bit of a smoother picture.
And maybe the 200-day moving average we've talked about in the past, but yeah, technicians sitting in their ivory towers with 35 computer screens. That's what they're looking at, things like this. So moving right along, I want to share two reasons why I believe it's important, or primary why the market is being driven higher. And I think firstly we have to talk about earnings. It's one of the primary forces that drive market sentiment. Of course, is one, but earnings. Of course, we talk about price to earnings ratios. That's the factor, the number of multiples of earnings you get in terms of stock valuations. And with 90% of S&P 500 companies reporting as of Friday afternoon, and of course we have a big superstar coming tomorrow, Wednesday, for earnings. That's NVIDIA stock. And we'll see what the market does with reaction to that. But that being said, I have adjusted earnings here at 9.5% up year over year. And if you allow me to include an asterisk there, that excludes, as LPL Research does, Zach, I thought this was intriguing. They just backed out. One company merged with another company, and then LPL Research and others backed out the merging costs. And if you do that, you got to a 9.5% year over year, which seems excellent. Consensus remains excellent for 2024 year over year. Earnings estimates are 11% above year over year. This is important. Companies are earning more. Their valuations are improved. It's supporting valuations where they are, I guess, is the point I'm making. So they've come in slightly better than expected. Would you agree?
Yeah, definitely have. And we had talked about this a few months ago, and about the high bar that earnings were going to have to clear in the second, third, and the third and fourth quarter are still very important as well, because we were pulling forward, I think, a lot of that optimism and that decoupling of the rate cut expectations, the fact that they are evaporating before our eyes, and the market is still making all-time highs, is really a function of these earnings coming in and clearing that bar, which was a very high bar of growth. And so we're even seeing those, if you see on the bottom right of that little graphic there, the forward earnings, the forward 12-month earnings, are continuing to increase and to clear those expectations. So yeah, it's been a pretty fantastic season.
Certainly one of the primary driving forces behind stock prices. What you see in the newspaper every day, earnings primary driver. and they're doing it very well. So that's ID number one. ID number two, which has been as important in the last several years, is just inflation prices. Just by way of background, right now I'm showing you a chart, but by way of background, so far this year, inflation has come in slightly higher than forecasts, a little bit incrementally higher. But last Wednesday, the April numbers came through and were in line with expectations for the first time so far this year, which is excellent. So core inflation, which as we've talked about before, X's out the important categories of energy and food, because you don't need those according to the government. But those two are volatile. 3.6% year over year, the lowest since April 2021, the lowest in 3 years. That was enough to drive the market throughout last week. But and going in the right direction. The point I want to make here, everyone's talking about, and I thought this chart in the Wall Street Journal from last week really kind of captured the zeitgeist, if you will, of the market. The last thing that's kind of remaining high is housing. The cost for home, your housing, I guess is what they call it. But they don't actually, in the inflation numbers, correct me if I'm wrong here, they don't actually count the value of houses because you can't really adjust that on a monthly basis, but they do.
Yeah, it's an imputed number. There's two components. The rent index is what you're seeing right here. And then there's also the owner's equivalent index, which kind of tries to be a proxy for housing cost.
So this has been really sticky. As you can imagine, you're only readjusting your lease once every 12 months, if that. And so housing, the good news is as of March, it was 5.6% year over year increase, down from 8.2% a year ago. That's pretty seismic, but it would need to go to 3.5% from the current 5.6 to start really affecting inflation in a positive way. But the chart I wanted to show here just very quickly, it's showing you 5 different components of ways that we can track the housing index from Zillow, from the BLS, Bureau of Labor Statistics. But the point I'm making here is that they all seem to be falling off a cliff. They're going in the right direction. I think we can anticipate that, even the BLS, Zach, I thought that was weird, almost at zero. You'd assume they'd have pretty similar metrics and variables inside their equations.
So there's two of them. There's actually the BLS all tenant is the second one, right below the CPI number, and the new tenant rent index is essentially renewals, right? So that's new rent that's coming online, and that's essentially flat, right? There's really no growth in new leases.
If you look over time, those seem to converge. So I suspect that we'll see that maybe it's just a longer tail. But anyway, I guess the point I'm making here just in passing is that inflation, came in line with expectations. It helps drive markets higher for reasons we've discussed previously and we'll continue to talk about, but not today. And then it seems like the last component of that is housing. And it seems like that's going in the right direction.
Yeah, and the other one that was really driving a lot, and I think we talked about it last time, was the auto insurance inflation.
Incredible! My God, I got my homeowner's reinsurance quotes this last month. Holy smokes!
Yeah, and so that component as well, we don't expect to continue to increase 20% year over year. That's just not sustainable. So those two main components, and it's interesting if you do look at the CPI. We're probably pretty glad it didn't follow those more volatile indexes on the way up too. That Zillow index got above 15%. But on the way down, it's kind of the same concept. It's not as volatile. It's not as quick to react. And so we're seeing all of the more kind of real-time, near-time indexes fall significantly, while that CPI still just drags a little bit.
It's going in the right direction. One big step back from the conversation on inflation. No one is talking about deflation right now, for good reason. Inflation has been stickier, but when no one's talking about something, it always puts my ears up. If home prices go through the floor, then there's going to be a big drag on inflation in general, and we could get back to where the Fed wants, or even lower than the Fed wants. So we'll keep an eye on that for you folks at home. So those are the two of the reasons why markets have continued to power higher and may continue to. I wanted to start by giving everyone at home one point of optimism here, why things could continue to grind higher throughout the rest of the year. This is from our friend Ryan Dietrich at Carson Wealth. He posted this on Twitter this week. And what he's talking about is the momentum in the marketplace and something unique that technicians follow. There were 3 consecutive days in a row that New York Stock Exchange constituents were up 74% or greater. And apparently that's only happened a handful of times going back to the year 2000. In the last 24 years, it's only happened 8 times, 8 for 8, which is a decent data set. Stocks were higher a year later, 8 for 8 times, 22% median return. So there is momentum. There is money coming off the sidelines, coming into stocks. You can find any variable you want for that, but this one isolated variable shows that when you have this type of momentum repeated for 3 days, looks pretty dang good for stocks in the long term. So it's one reason to stay the course.
Yeah,
which
super strong breadth. Yeah.
And unusual, right? Which is just interesting, coming off a great year last year, and just kind of a sense of where we are in the marketplace. So I'll just end there with one reason why I think it makes sense to stay optimistic. It's always, we're long-term investors here at Finance Footnotes, and I hope you are at home as well. So with that said, let me turn it over to you, Zach. What are we going to be talking about today?
Yeah, and final point on that is that we talked again about this in the past, where kind of our forecasting shows, and we had talked about the ways that the market could continue to advance higher, and one of them was the rest of the index and the other components catching up to the generals, right? The biggest market cap components that really drove the market last year, right? And those are still doing well for the most part. Tesla not so much, but we are seeing that breadth is expanding. The rest of the index is catching up when you have these days of 75% plus of the issues for 3 consecutive days advancing. That's a really strong signal.
Yeah. I didn't see anyone else talking about this other than Ryan Dietrich, but I think it's a powerful, when you add it to all the variables that we try to discuss here, I think it's certainly a positive. So I'll turn it over to you, my friend.
Yeah. The first one, I'm going to bump one of these up here because I just want to talk a little bit, because we're kind of on the subject of rates and the potential for them to get cut at some point. One of the benefits of them having raised interest rates is that the interest that you can earn on your money and in money markets and CDs and bank products has gone up as well. And so this is more of a practice management situation. If you have cash that's sitting in your savings account or in your checking account in excess of your daily cash flow needs, talk to your financial advisor, and let's get that money to work for you, because you can earn in excess of 5% on these money market instruments, FDIC insured CDs, whereas the national average rate on savings accounts still hasn't really budged. Your savings account is really only paying you 0.5%.
That's an incredible difference. Wow. I mean, so many people, I talk with clients all the time. What's your money? What's your savings account at the bank? I'm at 1%. My God, they're robbing you. You've got to come up with a solution. One idea to build on this, which may be appropriate for some, is to consider very short-term treasury notes. One benefit being that, they, for larger deposits, they're, the full backing of the federal government instead of the limits of the FDIC insurance, which, is just a minor point. Yep. But they're also at state. If you live in a high tax state, New Jersey, New York, or California, that state, the interest isn't taxed at the state level. Consult with your CPA, of course, but that could add, significant value. So out here in California, if you're getting 5.25% on a short-term treasury, the tax equivalent yield at the highest bracket would be closer to 6.5. So just food for thought for all of you at home.
Yeah, that's a great point. And I've been enjoying, doing cash management strategies for clients recently. It's been something
what a nerd you are, man. Oh, it says something like that.
Prior to 2022, it was kind of a useless conversation to have, right? There's really nothing I can do for it. Doesn't matter where your cash is. There's really nothing that we can do about it.
I'm really loving cash management, buddy.
But now we're able to, for folks who have, let's say they have a tax burden next year, or they're going to purchase a property in 2 years and they just don't want it invested in the market, but they're kind of just sitting in saving. It's like, well, okay, we can put a plan together where we can have a certain percentage of it in money market that's daily liquid. We can have a certain percentage of it in single U.S. treasuries, right? And kind of ladder those out to have maturities when you need them. So it's just been that kind of a something that's been new to the practice in the last couple of years, because for the better part of a decade, there was really just no options out there for your cash. So long story short, check where your cash is.
Yeah, double check your bank. Don't assume you're getting a good rate.
Don't assume that your bank is going to raise those rates on your savings accounts. Next thing I want to just dive into the kind of the third rail. It's the Social Security, and we saw a news article a week or two ago where the CBO had projected that the Social Security Trust Fund would be a little bit better than they had expected, and instead of running out in the early and not running out, but to not fund 100% of benefits. They pushed that back by a couple of years, but I think it's helpful to just understand this. And the longer that we wait to address this issue, the more painful it's going to be. And so by 2035, the Social Security revenue and benefits, the scheduled benefits, we know that the population is aging. We know that more people are going to be getting benefits. And the projected cut is 17%. They're going to have 83 cents on every dollar available reserves. Now, this will get changed as tax revenues and the economy, it'll get pushed back or pulled in a little bit. But sometime between 2035 and early 2040s, you're going to get into the situation where the trust fund is not going to be able to fully fund benefits. Now, when people say, hey, it's all the trust funds bankrupt, like that's not the case, right? They're going to still have 80+% available through the revenues that they collect from taxes to pay those benefits, right? And so it's not quite as a catastrophe as some folks would make it out to be. And there's some very simple things that they can do, very unpopular politically, but
that's why
there
they call
are
it the
some
third rail, as you
right.
may know at home. No one touches the third rail because that's the one that electrocutes you, and that's
Yeah.
what that's
Yeah.
that's
If
just to touch on that point, if I can quickly, because I was giving some presentations on this very topic, and I think there's a lot of fear tactics going around in our industry. But like you said,
Mhm.
it's no one wants to take a 70% haircut, but it's not the end of the world for most people. That being said, President Biden's proposal is actually to create a bit of a donut hole where you still have the same cap. As you may know, you pay Social Security up to a threshold of maybe just under $150,000 per person, and then
Mhm.
after that goes away for both you and your employer. And the president's proposal, which he's not very active on because it is the third rail, no one talks about
Mhm.
it, is that you would reinstitute that tax at something like $450,000 of income. So you'd have a middle ground where most people weren't affected, but the higher earners would, of course, pay that, and that would right the ship. So there are some solutions that
Yeah, that's yeah. I actually one of the proposals that I liked in that budget. I think it makes sense for folks to continue to pay into it. I would love to see some sort of private option, where you can essentially,
don't hold your
uh,
breath.
yeah, no, that'll probably never happen. But I would love to see it where for folks who are under the age of whatever 30, 35, where they can have some sort of option to defer their benefits into an account similar to a 401k, and really take ownership of it. I don't know if that'll ever come to fruition, but that would be nice. There's a couple other things that they can do, but I think that's probably the most impactful one is to raise that cap, on the benefits and or raise that cap on the tax, but then also to means test benefits, and it's again politically unpopular, extremely politically unpopular. It's like, well, I paid into the system my whole life and I'm not going to get it back. But the reality is, I think that there's plenty of folks in the country that just simply don't need Social Security benefits. And, if we want to, be the most advanced economy in the history of the world, then I think providing for folks who are less fortunate is a worthy goal. So that's another option that they would have is to means test it. Raising the retirement age, we already have a pretty high retirement age here in the U.S. compared to much of Europe and some of the rest of the developed economies. Wouldn't necessarily expect that to go too much higher, but between that proposal that you had mentioned and means testing, they could write this ship, right? It's not. It's not the end of the world. And I don't think that they're going to end up raising necessarily other taxes across the board. I don't think it's necessarily necessary. But the longer they wait, the more the more onerous it's going to become, you know. And my thought is that they're going to wait to the last minute, which because they always do. So it'll be 2034, 2035 before you see any change with this probably.
Yep, agreed.
The second chart is also just looking at why we're in this predicament. And this just shows that the number of workers per beneficiary has steadily been declining, since the essentially mid 1960s. There was that quick period after the post-war boom where there was, well overfunded, but it held pretty steady from 1965 until 2005, where you had about 3 1/3 workers per every beneficiary. And now we're in a situation where that has been starting to decrease fairly significantly and will continue to decrease for the rest of the century. And that's just a function of demographics. We're not having enough babies. We're not bringing in enough immigrants, and folks are just getting older. And so
to,
this
to,
problem,
to support the system as it is, I think, is the qualifier.
yeah, for sure. Oh yeah, absolutely. I mean, like we talked about, I mean, there's things you can do to change it, but um, the status quo is not sustainable, right? And this is why it's really just a demographic story, and we're not likely to change that. That takes a while, decades to turn around overall birth rates in a country. I think that there's many reasons why the birth rates are falling, but immigration is one that you could turn that, you could flick that switch pretty quickly. We could bring in more immigrants, which will help for this situation. I think it'll also help for the growth of the economy and for the labor market. So I'm hopeful that we do continue to bring in immigrants from abroad.
Well, that is a
I think
topic that's being discussed by both parties. So
it is.
we'll have
It
some
is.
come
Yeah.
this November, this very November, we'll have more answers on that topic.
Yeah, for sure. And I think that I don't love a lot of things that Canada does, but I think that their immigration conceptually with their point system, I think makes a lot of sense. If you have the ability to, if you have assets and you can support yourself
When
financially,
you have a
or you have
PhD in a field
advanced
that's
degrees,
yeah, you have a STEM degree in something that is required in that economy. Yeah, sure makes sense. And you
yeah,
hear a lot of
family
folks,
members already here.
especially in
Yeah,
Silicon Valley, complaining about getting highly qualified candidates from abroad. They
absolutely.
can't fill
Yeah,
them.
absolutely. And the lines are way too long. It takes 20, 30 years to get through these processes. So we really need to, streamline that process if we want to change this trajectory for this particular thing. Next thing I wanted to switch gears on and touch a little bit about, and again, this is kind of a political topic that doesn't affect that many people, but it does affect quite a number of folks that we come in contact with, and that's the estate tax. And this is set to sunset next year. The Trump Tax Cuts and Jobs Act expanded the estate tax exemption, to significantly, and it had a expiration date that would essentially cut it in half at the end of 2025 from 12.92 million, I believe it was. So almost 26 million per person, or per couple, per married couple. That's set to drop by a yet to be determined number. It'll be based off inflation, but the consensus is it'll be right around 15 million. So it's going to drop significantly. Now, a lot of folks who may not think that, oh, I'm not going to have a $15 million estate. If you have this chart, I think helps to show how the growth of your estate can over time put you into that category. So if you have a $2 or $3 million estate today, in 15, 20, 30 years, that most certainly could be over that exemption. And so I think that there's a lot of opportunity around this for you to work with your financial advisor, your tax advisor, and your estate attorney to put some strategies in place to help address this if you will potentially be in that situation. The thing about this particular cliff is that it doesn't require any act of Congress. It's already in the law. It would actually require an act of Congress to change it. And it's just one of those fairly politically unpopular things. I mean, most of the country is not too concerned with the estate tax going from 25 to 15 million, right? That's just not an issue that you're going to hear about at rallies or on the campaign trail all that much. So it doesn't require anything for this to happen, which I think is important.
Interesting on this topic, which has been, of course, top of mind for the affluent folks that we serve and work with. But I saw in the newspaper this morning that Janet Yellen, who is the head of was the head of the Federal Reserve and now is the Treasury Secretary, and she was signaling to our friends abroad that America is not interested in the recently floated 2% wealth tax, international wealth tax, to be lobbied by some new institution. This is floated by Brazil, who's going to be head of the monetary unit of the monetary part of the United Nations. Is a 20 country, but France is behind it. Germany's behind it at some level. So some major countries, shouldn't be billionaires. The top, billionaire tax, they call it 2%. America, even under a Democratic legislature, said no, we're not interested. So just interesting footnote here, because it is finance footnotes.
Yeah, no, I love the footnote. I'm personally very against wealth taxes in that regard. Income taxes, capital gains. Look, there's an argument to certainly be made that they could be higher for certain folks. That's a fine discussion to have. I think the logistics of implementing a wealth tax just make it essentially impossible to revalue. I mean, we just see how over the last 2 years, how quickly the value of a lot of these properties, corporate real estate, privately held companies. I mean, it changes so quickly and so drastically. I mean, how do you redo that every year? Well, by the time you do it, it could be completely irrelevant or completely out of favor with out of step with reality. And so I just think it's just a very difficult, if not impossible, policy to enact. So I'm glad to hear that somebody at the top levels of our government is saying that. And the final thing I have here, I just thought that I saw this recently. The no love for China, the percent of Americans that hold an unfavorable view of China, just since 2017, I mean, it was basically 50-50. Where you had an favorable view, a neutral view, right? It was like some people didn't like them, some people did. It was fine. It was very neutral. Now it's 81% have an unfavorable view of China.
What a majority, super majority.
A super majority. That would, that's a veto-proof majority, right? And I thought that was just really incredible. I mean, there's been a lot of rhetoric from both the Trump and Biden administrations on China. The Biden
it was just news this week about how President Biden is basically piggybacking former President Trump's tariff policy, just this week.
Yeah. Huge increases in a lot of situations, a lot of products.
Electric cars, solar panels, semiconductor, chips, like things that people need, inflationary, complicated, etc.
Yeah. Doubling and tripling of tariffs. So, but I think that this is important for the world in just the sense that, conflict between the U.S. and China, competition is great, right? Competition's good, and I do think that a lot of the tariff policies are warranted because of the subsidies that China government subsidies are placing, for certain industries and really propping them up and just making them essentially unable to compete. American companies are unable to compete, so I'm fine with the tariff policy. You just wonder, where does this go? And is this, a precursor to something
you don't have to wonder.
That's more dangerous?
China's already told us what they're going to do. And so
they did.
Our international
they
partners,
did.
I think it's one of the bigger risks to the 2024 election. We'll have to see what happens in November. If it's campaign bluster, or if it's followed through with, time will tell.
Yeah, and I think it's one of the bigger risks for the world over the next decade, really, and to have the United States, and China, just continuing to escalate,
and the EU, and it would be everybody.
So I don't necessarily think that this is a good trend to see this blow out so much over such a short time frame, to really have most of Americans agree on something. We don't agree on anything, right? I don't know if there's anything in the country. I don't know if there's anything in the country that you could run a poll on and 80+% would agree with it, except they're like puppies. Are puppies cute? Like maybe you would get 80% on that. Yeah. But it's a little bit just concerning because the first kind of step towards a real conflict is this, right? It's the sentiment, right? It's the othering, China's bad, right?
It also speaks to the power of rhetoric. What we see on television, it's been coming from both sides. It's been coming to us for 5 years now, and boy, it really shifts sentiment for sure. And part of it's tariffs, part of it's the Taiwan situation. It's wild.
Yeah, it's interesting, but something to certainly keep an eye on, in which we will do here on Finance and Footnotes for our lovely viewers.
Yes, my friends. Well, it was a quick. It wasn't that quick after all.
30 minutes. Yeah,
but hopefully you found some great value there. We'll be back to you in 2 short weeks. If you have questions, please let us know.